Hello, everyone. Welcome to the wonderful world of municipal bonds. Up on your screen right now, you're going to be looking at a municipal bond that was issued by the Michigan Central Railroad Company. And it's hard to read the specifics of the bond. You can see there's just a lot of small print legal information that's going on in here that talks about the authority of the Michigan Central Railroad Company and the rights of the investor who would buy this bond, and as well as providing some information on when the bond will start paying its interest costs and when the bond will mature. We can't see most of that in here. I couldn't find one that provided all the detail that I wanted to show, but this gives you some sense of what this bond would be. And let's just assume that it is a 10-year bond, and so we'll operate with it as though it's a 10-year bond here. What we can see is that it is that this bond has a face value of $1,000, meaning that if you had purchased this bond and this someone has got these coupons and they've put them on the side of this bond, but if you had bought this bond, that after the 10 years or whatever the maturity term is, you would take this bond paper into the bank that was servicing the bond, and you would, as the investor, if you had bought this bond, you would turn it in and get your $1,000. And as an interest payment, the the Michigan Central Railroad Company would pay you a coupon every 6 months from the time you purchased the bond, if you bought it when it was issued, all the way up to its maturity. And you can see these little coupons are actually the little paper that would be perforated, and you would tear it off and you would take it into the bank that is that's servicing the debt from the issuer. So the Michigan Central Railroad Company would put money in there, and then you would take it to the bank, and the bank would pay you out your coupon payment. And each one of these coupon payments is going to pay on a 3.5% interest. So that's written here at the top. That's an annual rate, and these are semi-annual coupons. You probably can't see very well, but this top one has May of 1 year, and then here is November, and then May, November. So every 6 months, one of these coupons is getting paid out at this 3.5%. That's an annual rate, and so if we want to figure out what any given coupon payment would be, it would just be this we would just take the face value of the bond and multiply it by the 3.5% divided by 2 to make it semi-annual. And so every 6 months, an investor who owns this bond will be able to take an interest payment of $17.50. So this would be a flow every 6 months through the maturity of the bond. And then at the very last date, they would take their last coupon in and redeem the last coupon and redeem the face value of the bond, the $1,000. So that's kind of what a bond looks like. Let's look at a really, this is the high production value of this class here. So here we have another bond that I've made up that has here a fictitious city, right? And then it's a $5,000 par value or face value. So this would be the amount that would get paid out at the final maturity. And we'll say that the coupons are based on an annual coupon rate of 5%. And whenever we are quoted a coupon rate, that's typically the annual rate, and then we just need to know whether it's paid out semi-annually or annually. This one is an annual coupon rate, and we're going to the default in the municipal market is to pay out at semi-annual payments, the coupons at semi-annual payments. And then the maturity will be whatever the date is. It'll be 5 years from now at issue. And so here are the coupon values, and these coupon values that I have of $125, you should be able to calculate that. I'll give you a second to think about how you would do that. Essentially, we just need to take the 5% coupon rate and divide it by 2 to get the semi-annual rate, and then we'll just take that value, the 2.5%, and multiply it by the face value of the bond. So the face value of the bond and the coupon rate are used to determine what the coupon payments are going to be. So now we have all of the cash flows that the issuer of the bond, the city or school district or county or state, the issuer is whoever is the one who is going into debt and issuing the debt to the investor. They're going to make, we know their cash flows are going to be this $125 every 6 months for 5 years, and a $5,000 flow at the end back to the investor. So let's work this through in Excel. How would we calculate how much money the investor will give to the issuer for this bond? How much? What will be the proceeds for the issuer? Proceeds meaning how much they will be able to bring in. So we've got a par value of 5,000. We can call this also the face value. We have a coupon rate of 5% and semi-annually at 2.5%. This is a very normal coupon rate. We have a term in years, or the maturity term is 5 years, and we have number of periods, therefore, is 10, because we're dealing with the semi-annual compounding frequency. And the coupon payment will be $125, as we determined in the previous screen. So we can use our time value of money functions to calculate what the present value of the coupon payment would be, as well as the present value of the face value of the bond would be. So let's do that in separate entries right now. We'll do the present value of the coupon payments. We'll do the present value of the face value of the bond, and then we'll do the total present value of the bond. So what do we have here to calculate the present value of the coupon payments? You want to think about what your inputs would be here for a second. Now there's one little bit of information here on the screen that I haven't talked about yet, and that is critical for us to be able to make this, to do this calculation, which is the yield to maturity for a bond that would be a 5-year bond. And so I have written in this yield to maturity. We can find yields to maturity by going online, and this yield may actually be a little high for current market. So let me go in here. I'll look. What you see on the screen is just as of the date I'm recording this video. It is the yield curve for one of the Bloomberg indices, and I can come down here to a 5-year maturity. The yields are, I don't know if you can see that on your screen, 1.254%. So we'll go back here. This should be 1.254. That's if this is a AAA bond and conform, there's some variation around that average, but the index will average what is being observed in the marketplace. This would be a typical market rate. So now we can calculate the present value of the coupon payment. And once again, this will be the amount that the investor will be willing to pay in order to acquire the coupon payment. And it's also the amount that the investor is therefore giving to the issuer of the bond, the hometown city, in order to engage in this financial transaction. Now, of course, this is a simplified example, so we're not including various closing costs and other fees that could be involved from an underwriter or other kinds of financial participants in the deal. But this will give us a good general simple calculation. So we're going to use the present value formula here, or function. And the first thing that we need to do is identify the rate. Now, this is one of the most important things for you to recognize, which is that the rate up here, the coupon rate, is only used to determine what the coupon payment is going to be. The coupon rate is not the rate that goes into calculating the present value of the bond. The present value of the bond, or how much the investor will be willing to pay, is determined by what the market rate is. Now, the investor is not really concerned about this being a 5% or a 2.5% semi-annual coupon rate. They're just recognize that they're going to get this cash flow, $125 every 6 months, and $5,000 at the end of the final month. So they want to buy it at the current market rate for tying up your money for 5 years at a semi-annual rate. So we will use this yield to maturity figure. That's the market rate. That's how much market demands to receive as a return in exchange for this cash flow. So I will just grab this market yield, but that's an annual representation, so I'm going to divide it by 2. And then the number of periods will be the 10 semi-annual periods. The coupon value is going to be this $175. And I'll just bring that in. I'm going to, as a positive value, it's going to produce a negative value. That's essentially how much the investor is going to pay out. I'm looking at this, I guess, from the investor's perspective primarily as, in these calculations. So the investor will pay $1,207.95 to get this coupon. So if they didn't care about this par value, all they wanted was this coupon, this is how much they would give Hometown City. Now, what would they do if they were wanting only the face value? And there's a kind of a bond called a zero coupon bond, which is one that's just like this, where you would have just like this calculation I'm about to do, where you would have a $5,000 face value, but ignore the coupon. The federal government, federal treasuries, savings bonds, sometimes those are in that environment. There's more likely to have a zero coupon, where you buy the bond at a discounted amount of what the future cash flow will be. So we'll just take that market rate here and divide it by 2 so that we're compounding semi-annually. Then we want to identify that it's 10 time periods, and we're ignoring the coupons, so I'm just going to skip past the PMT, and then I'll just go up here to the future value, and I'll capture that. So the amount that the investor is going to pay in order to get this, the face value, is something less than the $5,000, right? Because they need to get this return on their investment. So they'll give $4,697.05 in order to produce this a 1.254 return for the fixed amount that they're going to receive 5 years in the future. That's why bond markets are referred to as fixed investment markets, because the cash flows are fixed in the future, and what happens is we price how much we'd be willing to pay for the bond based on knowing what those fixed future flows are at the rate that we demand, or the rate that we expect to be fair in the marketplace. So now we have two ways we could do this next one, the total present value of the bond. We could just sum these two components, because that's all we're getting above for this bond is the sum of these two, the coupons and the face value, and that would be $5,905 that an investor would pay in order to get this amount of money. 4,697 of it is for this cash flow at to gain this interest rate that we have, and $1,207 is for these coupon payments producing this investment. But we could also just have done the calculation all in one, right? We could take this yield to maturity, divide it by 2 to put it in semi-annual terms, then bring in the number of periods, then bring in the coupon, and bring in the par value or the face value, which is a future lump sum cash flow. And then we'll just do that one calculation. And you can see that this value and this value are the same, because this calculation right here is just incorporating both of these two components all together in one. Now, why is this amount of the proceeds on the bond, or the price on that bond, why would it be larger than 5,000? Well, it's larger than 5,000 because the coupon rate is paying an interest payment that is far higher than is demanded by the yield. If the market yield is equal to, or if the coupon rate is equal to the market yield, then we will see that this will all turn out to just be equal. This will just be 5,000. So I'll actually make that calculation here. I'll just put 1.254 in here, and everything should adjust. And you can see if the coupon payment is set to pay exactly at the market rate, then the investor will pay $5,000, and part of that $5,000 was actually for the coupons, and part of it was for the face value of the bond. Anyway, hopefully that gives you some indication of how this works. So go back to the original calculation, and will help you be able to understand how to do your own calculations of the price and proceeds of a single municipal bond.